So now that we have the income statement constructed, let's go ahead and use the income statement's inputs and assumptions above to connect it to the NPV model down below. So we have our basic layout in terms of having our periods, our cash flows in, our cash flows net, our present value, NPV and IRR. So let's go ahead and just deal with it one area at a time by first putting in our formula for cash flows net as being equal to our ins minus our outs. Then let's go a column at a time and find out what all the inputs actually are as it relates to this investment. So the first thing we have is this initial investment cash flow out of $10 million. Now, pay attention carefully here because the revenues are always going to be our sole source of cash flows in. But when it comes to expenses, the cash flows out that we will use are always cost of goods and sales general administration and interest and tax. Notice that we intentionally are ignoring the depreciation line. So there is our total cash flows out. So we get those put in there throughout the entire timeline. And then the last thing that we have to do is recognize that we do have this resale of $500,000 in the very end as a supplemental cash flow from investment in. And now we have a fully built timeline. So now let's go ahead and at the end of the day remind ourselves that finance is all about plotting cash flows at specific points on the timeline and then discounting them by the opportunity cost of capital to get net present value. Don't forget the step of switching the sign on the present value to trick Excel so that we see that the present value of 10 million out now is a cash flow net of negative 10 million, and it also represents a present value of negative 10 million. We copy and paste that across. Now we know that NPV is simply the sum of all of our present values, and we end up with a negative NPV of approximately $600,000. Let's go ahead and solve for our IRR by using our cash flows net as our inputs, and you see we have an IRR of about 8.5%. With a discount rate then of 10%, it's clear that this project's return is less than what our required return is, which then also indicates for us how we would have a negative NPV. And so this would be a project that we would not be interested in pursuing.